Hi, I'm Mark Hebner, President of Index Fund Advisors, and welcome to the quarterly market review for the first quarter of 2020, the at-home edition. Still quarantined at home, but Robert and I are going to try to put this together for you, and hopefully it will all be nice and clear, and you'll be able to get the same information that we've been giving you when we used our green screen in our studio. So let's take a look at some of the summary of market data for this first quarter, like we always do. And you can see that the coronavirus has gripped markets, and markets have repriced themselves for positive returns. There's something for you to think about. And here we see that U.S. stocks have been down about, or were down 20.9% for this first quarter of 2020. International developed stocks, which are a little riskier than the US, are down 23.26, and emerging markets are down 23.6, and global real estate is down 29%. Maybe people are thinking that people are going to cancel their lease after seeing how well this at home works, huh? Who knows? But real estate's down 29% on a global basis. Good, safe bonds are up nicely at 3.15% in the US and 0.5% on a global basis. So that's a little overview of general markets around the world. We always like to look at the news that drives the changes in prices of the MSCI All Country World Index. But this quarter, we're pretty much dominated by one story, and that is the coronavirus. But it is kind of interesting to see the timing of the changes in the market as we think back what we knew about the virus. So early in the year, you can see that this virus was discovered by Chinese scientists investigating the pneumonia outbreak that they had in probably Wuhan here. It doesn't say that, but that's pretty much what we know about. And the market wasn't too concerned about it at that point because I don't think a whole lot of people knew. January, pretty much throughout the month, we went along pretty good. We now know that there were some cases that were known to have occurred in January and February, early February, that at the time we didn't really know was the coronavirus. But around February 19th is when you see this drop, was when the market started to show signs that, and when I say the market, I mean all the 10 million buyers and sellers in the world started to realize that this might be a problem for the profits and the expected returns of their investments. And the way markets work is the buyers basically say to the sellers in this invisible conversation, listen, if you want me to buy these shares, stocks or bonds, I need to get a lower price so I'm positioned for my fair return. And here you see what happened as the news became worse, the price became lower. And then near the end, probably mid to late March here, all of a sudden we started to see the light at the end of the tunnel. We started to see that China was going back to work, and they had gotten through the worst of their cases there, and markets started to recover a little bit. Then they took another little dip. Who knows, maybe people started thinking about what this impact would be on the future earnings and the prospects of future returns. All right. The global breakdown, according to the design of our the dimensional portfolios, came out something like this by the end of the quarter with a total market capitalization of around $44.6 trillion. You see here in the US, we made up about 56% of the world allocation. Those international developed came in about 32%, while the emerging markets remain fairly steady here at around 12%. So there's a whole industry out there of tactical asset allocators who like to look at the past returns of various asset classes, move around your portfolio and try to put you in position so that in the next quarter, you'll maximize your return according to their forecasts. Well, good luck finding somebody who made this forecast because at the end of 2019, markets look pretty good. So when we look back, we see the winners back then were international small company and international small value, two asset classes that haven't done so well over the years, by the way. Emerging markets, another asset class that hasn't done well for a while, up 10%. Emerging markets, small cap, up 10%. Emerging market value. In fact, interesting, if we have Roth accounts, we like to put the highest expected return asset classes in those Roth accounts. And those are the 5 that are candidates for Roth accounts because they have the highest expected return over the long haul. Finally, they've had a nice little quarter there. But don't get too excited because in the next quarter, it looked nothing like the last quarter. And here we see that all of those asset classes, in fact, all equity asset classes, took a major hit as we experienced the grip of this virus, coronavirus, COVID-19, COVID, whatever you want to call it, around the world, sent us all to our homes into lockdown. But you see those large companies in the US, which are the safest companies on the planet, really, ended up with the lowest decline at a minus 19.6%, which is something you pretty much would expect. Remember, risk and return are related. And part of risk is a larger decline in bad markets. In fact, Bill Sharp was once asked, what investments have the highest returns? And he said, well, that's easy. It's those that lose the most in a bad market. So here you can see pretty clear. We have a number of asset classes that have had the highest very long-term returns, 20, 30 years, like IFA US small cap value. And then in this period where we had a lot of bad news, we see that it had the largest loss here at 39.19 for that quarter. Now in the fixed income side, because fixed income is safe, an average duration around 2.5 years, and an average credit rating around AA. And so pretty safe. And so pretty much you throw a lot of bad news at safe bonds and they still hold up fairly well. And you can see that those were pretty consistent over the 2 periods. But imagine you were trying to time an asset class based on what happened in Q4 of 2019 and Q1 comes along and you'd be in for some big surprises. Now, instead of trying to dig into all the pieces of the portfolio, and I'm often reminding our clients that you really should just think about your portfolio as a whole and not try to get in there and mess around and try to forecast and predict and be worried about individual pieces because it'll drive you crazy because of the randomness of asset class returns, as you just saw. Instead, if we think of our portfolios as whole portfolios, now we can see in the fourth quarter, stocks were up. And so portfolio 100, the all stock index portfolio, was up 8.6% for that quarter. And as you dilute that with fixed income, you see a nice, neat pattern. And you see the same pattern, just on the opposite side, when equity returns reversed and became losses. So the nice thing about looking at your whole portfolio, as opposed to looking at all these individual pieces, is things make a lot more sense. And when they make more sense, it's a lot easier for you to hold on to your investments through volatile times. We're going to talk about that in just a minute. Now, once again, we always like to focus on the long term. Why is the long term important? It basically gives you a larger sample. In this case, it's actually what statisticians might call the population of quality data about stock market returns. The other interesting thing is, even this was a big dip, to see that dip at the end of this long line, it's partly because it's a logarithmic scale here, but it just seems like a little blip on this growth of your wealth, growth of, in this case, $1 over this 92-year and 3-month period. But you can see here that $1 would have grown $10,575 in this simulated hypothetical backtested performance portfolio 100. That's a short way of saying there's a lot that goes into the construction of this data. And I'd urge you to go to IFA.com and click on the backtested performance data and the index construction data. Index is the explanation of what's in these indexes. But anyway, as you dilute that full equity portfolio with fixed income, you can see a substantial reduction in the growth of the wealth over this 92-year period. And of course, the shorter that is, the less this variance. But it's a great reminder that if you just bought a one treasury bill, $1 only grew to $20, where instead, if you'd owned equities the way we construct it, it's looking more like $10,000. And that's some justification for wanting to hold equities in your portfolio. By the way, inflation over this period is pretty close to that treasury bill. And so that takes that $20 of that 1-month treasury bill and probably takes it down to, I don't know, I'm just going to guess, around $2. It's something very, the T-bill return is very close to inflation over these long periods of time. All right. Well, that wraps up my initial discussion about the first quarter of 2020. Because of all the issues that are going with the coronavirus, I want to talk about a couple other things that I want to just tag on at the end of this review. So the first thing I want to discuss is this idea that clients can kind of step out of the way of what they think is a falling market. You know, we don't allow our advisors to use falling at A, because really all we know is what the markets have done. It's always the past tense when you're discussing markets, because the future is a equal chance it'll go up and down, up or down around a fair return. Now, people don't always accept that, but it has to do with the fact that it's a fair price. And if it's a fair price, then it would be an equal chance that it would go up or down. So it's really hard for you to say fall in. All we can say is fall in. But what are the problems with you trying to make adjustments to your portfolio, in particular, moving your portfolio to cash or making significant changes in the risk exposure of your portfolio? And this graph, I think, does a great job in explaining this. I've already explained it in some of the other videos we've done, but I want to include it with this quarterly review. Besides, most of us, including me, need to hear something probably 3 times for it to really sink in and start to make sense to them. So this is a little summary, and a very nice summary, of the real problem with trying to be a market timer. And that is missing out on the big return days. So I'm sure if you watch the market, although lately we've had pretty wild swings, before the coronavirus anyway, it was very unusual to see days much beyond 3%. And we would say in a year, maybe 3 or maybe a couple 3% days and a couple 2% days. And so what that says is, and the market's doing, let's say 10% a year, it only takes a few days that you missed to end up with a zero return in your portfolio. Well, now I'm going to expand this to a 20-year period, and it's really kind of shocking. Everybody who looks at this goes, wow. So here's a 5,035-day period where we look at the S&P over this 20 years from 2000 to 2019. By the way, that's not such great return for the S&P. The long-term return is more like 9.4 or something like that, just for the index. And you see here it was 6.02 for this period. So what does that do if you had $10,000? Well, it basically turns it into $32,192. Now that's a gain on your investment of $22,192, right? Because you started with 10,000, so we have to take that out. What happens if just you missed 5 days over 20 years, or 5,035 days? That return drops down to 3.87. The growth of your 10,000 drops to 21,000. Your gain basically gets cut in half, minus 48.81% reduction in the gain on your investment. That's dramatic. And only 5 out of 5,000 days? This is why you must stay invested. You don't know when these days are coming along. We had one not too long ago where the market went up 9.5%. Believe me, if you didn't capture that 9.5 because you sold, let's say the day, and then you didn't get back in till the next day, just imagine what that does to your long-term return. It clobbers it. So there were more of those. I remember one of those 10% days in 2008. Anyway, now let's take out 10 days. Your return drops to 2.4, and you lose 72% of your gain. At 20 days over 20 years, an average of 1 day per year, you basically have lost all of your gain, 99.3%. See ya, gone. At 40 days, you really are experimenting with market timing. You're now actually negative, and your 10,000 turned into 4,615. So it's no wonder that many of us in the industry think of market timing as probably your single worst investment strategy. So please don't do that. Despite all our education, and I'm not trying to make anybody feel bad who's watching this, I understand it's very emotional and very difficult to write out market losses. But if you do sell or do make dramatic changes in your portfolio, it is not likely to work out to your benefit. You might sleep a little better, but as Apollo from Dimensional said in the last town hall we did, you're going to trade out being nervous about when you should out to be nervous about when I should get back in. And you just trade one emotion with another. Okay. So the other thing I want to talk about is the likelihood of a recovery of your portfolio. Okay. The likelihood of recovery is tied to the fact that the job of a free market is to reset prices so investors are expected to get a positive return in the future. And here you can see the average recovery after a 10% decline, a 20% decline, and a 30% decline. Well, since this quarter was closer to the 30% decline, maybe we should just focus on this. And I'm going to show you the actual days, the day-to-day decline of these periods. So here you can see that the total return after a 30% market decline was 14.4% on average in 1-year periods. Over 3-year periods, it averaged a total now, this is not an annual return, a total return of 16%. And over 5-year periods, that's a total return of 50% over the 5 years after a 30% decline. And down here, for those intellectually curious that like to visit IFA.com, we actually tell you the exact periods where we saw portfolios down 30% from one day to the next. And of course, this is during the Great Depression. And during that very difficult period, 5 years later, you were still down 42%. But I just want to remind everybody, during that period, there were no rules on margining, and people margined their securities and really got in trouble through high levels of leverage of their portfolios, because it didn't take as much of a time to get them wiped out, and that created enormous havoc in the markets. But in 1968, another period where we had a large decline, but look at the year after, 41%, then 35. And you see that all of these other periods, we had a very nice recovery. So bottom line is, don't let fear or greed drive your emotions and drive you into making mistakes in your portfolio. Instead, focus on learning about markets, learning about how markets reset prices so that they're positioned to get a fair return in the future, as you see in my little Hebner model here. And really, don't worry, because you're actually protected as investors as buyers and sellers reset prices, so you're positioned to get your fair return. Who knows exactly what that number is, but that's 600-month average for all of these. So you're positioned to get that fair return in the future. All right, well, that's our quarterly review for the first quarter of 2020. And hopefully we'll be doing this from our studio next time. Thank you for listening.